Hey, Money Masters, how are you all? Hope you guys are doing well today. Looks like I'm kind of bleeding through my background. But anyhow, listen, it's Freedom Friday, right? We have our Freedom Friday chat. And obviously, by the title, what I try to do when we come together on Fridays is to provide you some information that is going to help you to become free. Free in your, not just physically in your money physically, but more importantly, free here, because when you're free here, then everything else will follow, right? So let's get started. Today, I wanted to talk about the news and the emotionalism of the news, right? Especially when they are reporting, when they're reporting on anything, but especially when they're reporting on the stock market, right? So if the news is where you are consistently getting your information regarding the stock market, then you are going to definitely want to listen carefully here. And then you're definitely going to want to change the channels that you are using. And I don't mean from CBS to ABC. I mean, you have to change where you're getting your news from about the stock market from. We do not want to get it in mainstream television news programs because they have an agenda overall when reporting the news, right? Their thing is to get people emotionally stirred up in these stories, okay? And so therefore that's why they use a lot of the colorful words that they use, a lot of words that can either make you feel really angry or really happy, and mostly for the news, right, it's not the really happy, it's usually on the other end of things, right? And especially in the stock market, they use words like, oh, the market crashed today, right? Whether it really crashed or not. Or they use words like the market soared, so you want to be careful getting your news, um, getting your information about the stock market from traditional news channels. Instead, you want to get your news from some more credible places. Yahoo Finance does a really good job. Um, and that is really good just for, everyday people, right? You're not a advisor, you're not in the financial, working in the financial services industry, helping clients invest and things like that. So Yahoo Finance is a really good place for you to to get some news, to get information on the stock market. And there are a lot of other good places too, but you can start there. Okay. So let's talk about this. What I want to do is teach you some terms that you'll hear, particularly terms we've been hearing lately, right? As the market has been really volatile. What does that mean? The market has been up and down, up and down, up and down. That's what volatile means. Okay. And so, and we've seen a lot of down lately. So there have been some terms that you may be hearing if you're paying attention. And one of those terms is market correction. The other term is bear market. Okay. So we want to talk about what these terms really mean and how do we navigate that when something is going on. Okay. So let's talk about market correction. So market correction just means that the market is down, and it is down more than 10%, okay, but not more than 20%. Okay, so the market is down somewhere between 10 and 20%. All right. Once it gets to 20% is something else. But that's what a market correction is. And I'm going to come back and talk about these terms a little more deeply, but market correction, that's what that is. And then bear market means that the stock market is down over 20%. Okay, so 20% plus. The stock market is down, or they'll say 20 points. Okay, Now, the stock market is a financial term that's used to refer to the trading of stocks. And let's think about this. Okay, let's just put our thinking caps on. I remember when I was in elementary school, our kindergarten teacher would say, a lot of our teachers said, let's put our thinking caps on, right? So let's just put our thinking caps on and let's logically think through this, okay? So the stock market is made up of, and if you're watching live, I forgot to say, let me know that you're watching and where you're watching from. Even if you're watching the replay, let me know, because I always want to acknowledge and thank people for tuning in. Okay, so the stock market is made up of what? Made up of a lot of companies that have what they're called securities, okay, that they are selling. The securities, they're selling and buying going on, okay? The securities are a way for these companies, okay, or stocks are a way for these companies, I should say, so the difference between securities and stock. Securities includes stock, bonds, mutual funds, ETFs, anything that is, traded, publicly traded. Those are securities, okay? And then when I say stock, now we're talking about individual uh, companies that are using stock as a way to raise capital for whatever it is that they need to take care of, operations, whatever the case may be, right? So when a company goes public, that means that they have been registered with the Securities Exchange. They are able to sell shares of their company, okay, shares of stock in their company. And so what does that allow you as the investor to become? You have ownership in the company, okay? Anytime you purchase stock from a company, you have ownership in that company, okay? And you now have become a shareholder of that company. Well, now let's talk about just business, business ownership. Not business ownership per se, but the life cycle of a business. Okay. So there's a life cycle to business, right? When you first open a business or you start a business, like you're in the startup phase. Then you go from the startup phase to the growth phase. Then you go from the growth phase to the peak phase. And then there are a couple of things that can happen from there. Okay. You can either decline from the peak phase, okay, or you can make sure that you're doing something to stay relevant and kind of start that cycle again, or just stay uh, up there. You maintain. Okay. So companies that are like maintaining, really companies like Walmart, um, that's a good example, right? Nike, all these big name companies that have been around for a long time. Those companies have found a way to go from startup to growth, to peak, and then maintain. Okay. If a company does not stay relevant, does not, they're not able to maintain, and so they can go down. Now, why am I telling you this? Because the life cycle of a company has everything to do, um, has a lot to do. I won't say everything to do, but has a lot to do with the stock prices. Okay, and when we talk about stock prices, the market volatility, when we talk about market corrections, the bear market, all of that has to do with pricing of the stock. Okay. And so a company in the startup phase, they're first going public on the securities exchange, their stock prices may be very low. Okay. Then, as they're going into growth phase, their stock prices will increase. Sometimes they will increase dramatically, and they may or may not even be worth the price that they're being sold at, but they're in this growth phase with great projections, right? Then they reach a peak. And so their stock prices may kind of, maintain or just continue to grow at a very steady rate, right? And then if a company um, after their peak, they're not able to maintain. They, let's say, they bomb, right? Or they're bombing on their way down and out, then their stock prices drop again. Okay. So when the market is up, okay, there's a term for it called the market is bullish, or yes, it's up, or people think the market is going up, then that means stock prices are going up. Okay. But we're not talking about bullish today. We're talking about market corrections and bear market, simply because these are the terms that have been in the news lately. So I wanted to address them. So again, here we go. Market correction means that the market is down 10%, okay, or more, but not more than 20%. So somewhere between 10 and 20% is a market correction. Now, market correction happens on average about every 17 and a half months. Okay. Why am I telling you this? Because as an investor, you need to understand this. At the top of this program, this broadcast, I was saying that, the news, when they report about the stock market, it's very sensationalized. They use a lot of emotional terms. And so when we talk about, oh, the market has crashed, you're like, well, what does that really mean? Is the market down between 10 and 20 points? Because if so, that's just a market correction. And market corrections happen. They happen on average every 17 and a half months. Okay. And so the market correction, um, basically what's going on is that investors are really more motivated to sell at that time than they are to buy stock. Okay. So there's a lot of selling going on. And that's what causes a market correction. Okay. The supply, and demand, it's simple supply and demand, basically. Okay. So investors are selling off. Okay. Hardly anyone is buying. Okay. So there's more out there. Um, the market is, not necessarily saturated either, but there's just a lot more out there. Okay. No, more people are selling versus buying. That is what a market correction is. Okay. Happens every 17 and a half months. Okay. So we can just expect it. Okay. If we look at the history of the market from the time that it has been in existence, we have learned that this happens about every 17 and a half months. Can we predict with all certainty that it happens every 17 and a half months? Not necessarily, but again, looking at the average from the time the market has been in place, it's been about every 17 and a half months. So when you're listening to the news and they say, oh, the market has crashed, and you look and see that, oh, it's only between 10 and 20%, that's a market correction. And yeah, we're typically due for one. Okay. Now let's talk about bear market. Okay. What a bear market is. So a bear market, she says, is this a good time to buy? And it definitely is a good time to buy. And I'm sorry that I can't call you by name because all it's showing me is just Facebook user. But it's definitely a good time to buy. And I'm going to tell you why in just a moment. Bear market means that the market is down. Okay. Bear down. So that's for us as financial advisors, when we're learning, that helps us to remember that bear means the market is down. Okay, I'm going to bear down. So market is down. The market in a bear market, the market is down 20%. Okay, or more. Okay, 20% or more. So, and what's down 20%? The prices. Okay. Remember, I talked about the phase of the company and how their prices can go up depending upon what phase they're in, and then they can drop again depending upon what's going on. All right. So, with a bear market, the market has declined, their prices declined more than 20%. Now, with a bear market, the underlying cause of that, because with a market correction, we said the underlying cause is that investors are just selling, okay, more than they are buying. But with a bear market, what often the underlying reason for a bear market is what they call negative sentiment, okay, and declining economic prospects. In other words, There's a lot of things that are going on in the world that is causing some negative sentiment. So, for example, the war in Ukraine or Russia, which initially, when it's announced, it causes some negative investor sentiment. The pandemic, okay, in 2020 caused some negative investor sentiment, right? So bear markets can be, cyclical, or, they can be longer term. In fact, bear markets happen on an average of every 4 years. Okay. So again, thinking about, thinking logically about this thing and not going by traditional news and the words they love to use to sensationalize things. When you hear the market is down, and even if you hear it's down 20 plus points, they try to make it sound like it's a horrible thing. But in actuality, it's a great time to buy, okay, during a market correction or during a bear market, because the prices have dropped. Okay. I like to say to the women that the market is on sale because, as women, whatever we're into, whether it's shoes or purses, or me, it's books and all this kind of stuff, right? Whatever we're into, when there is a sale, we get super excited. We get out there and we might buy, I like these pair of shoes. I'm going to get them in every color because it's on sale, right? So we don't need to be afraid of market corrections. We don't need to be afraid of the bear market, okay? The only time you want to get nervous about that is if you are, within 5 years, 6 years or so of retirement. You might, want to pull some of your monies out and put them in safer investments. Okay. That's the only time that you want to, be a little nervous about a bear market. Okay. Because obviously, if you're getting ready to retire in the next 3 to 5 years, 6 years, then you want to make sure that your money is going to be there, right? And so sometimes when the market is drops, and depending on how long it stays that way, you may not have enough time to recoup losses. Okay, so that is what's meant by market correction. That is what's meant by bear market. Those are the things you need to be thinking about when if you're watching traditional news for stock, which I do not advise. Like I said, do Yahoo Finance or something else other than traditional news stations. But if you're watching traditional news stations and you hear that, oh, the market crashed, your first thought should be, well, is this a market correction? Is this a bear market? What exactly is going on? But in either case, whether it's a market correction or whether it's a bear market, whatever it is, it's a good time to buy if you're in the market for the long term. Okay. I hope that makes sense. Okay. Let us not get caught up in all the emotionalism of traditional news media when they're out here reporting what's going on with the market. Yesterday, the market had a great day, right? And the other thing is, for the average person who's investing, like if you're just, I've got my retirement, I've got my emergency investment fund, I've got, if you just have the basic things, you're not an avid investor like that, I don't advise that you watch what's going on in the market on a daily basis, because it's up and down, up and down, up and down every day, right? Yesterday, when the market closed, it ended on an up note. I think it was up 350 points. And I posted something about that yesterday. Today, who knows? We'll see, right? But it's up, down, up, down, up, down every day. So there's no need really to look at your investments every day if you're investing for the long term. If you're a short-term investor, meaning you put some money in, you're probably going to get it out in a week or two, or you do day trading, then you want to watch the market every day. But other than that, you do not have a need to watch the market every day. It'll probably just give you heart palpitations, right? If you don't really understand what's going on. Okay. But I'm trying to share with you so that you don't have those heart palpitations. even when you're checking in on your investments quarterly. And that's what you should do. Your statements come from your investment company quarterly. So you should be looking at your investments quarterly, and you should have an advisor that is accessible and reachable in case you have any questions about your statement. I know with my clients, I usually provide for them an option to meet with me either yearly, semi annually, or quarterly based on their comfort, right? In the beginning, when I'm first meeting with my clients and we first get them invested, I kind of touch base with them um, for the once a quarter in that first year. Okay, especially if it's someone who doesn't really know a whole lot about the market. So I want to make sure they're okay with everything that's going on. They understand what's going on, right? But then after that first year, it may go to semi-annual. That we touch base. If they want to stay quarterly, touching base, we can do that. Um, then we move to semi-annual, right? And then annual if that's what they want, right? Definitely no less than annual. Okay, so you should have, if you have investments and you have an advisor, um, you should be, they should be kind of checking in, right? It's very easy. I've seen a lot of advisors do this. They invest your funds and then you don't hear from them for years. Um, and I just think, we should touch base a little bit more than that. And those conversations are not long. Just, hey, did you see your statement? Do you have any questions? Me just telling them everything is well, you're on track, whatever, So anyway, I hope that the broadcast today has been helpful for you. It is a good time if you're not invested at all. This is a good time to get in and invest. Prices are down. Of course, I'm going to encourage you to highly reach out to me and set up some time so that we can talk about it. Because if you've never invested before, you don't want to just throw some money in there, right? You got to have a strategy. You got to have a strategy. Why are we investing? Is it for retirement? Um, is it for short term? What is it for? What's the goal, right? And then we got to put a strategy in place. And when you have a strategy in place, then you can determine what type of investments you need, right? All right. So thank you. Great broadcast. You're very, very welcome. All right. So that's all that I have for you all today. Hope that, again, this is Freedom Friday, a Freedom Friday broadcast where I want to help you to be free of some of the limiting beliefs that we have surrounding money, be free here in the mind, because when you're free in the mind and have a healthy money mindset, that helps you to then take action and do much better in your finances, getting you on a path to financial freedom. We are on a mission to change the face of wealth. Yes, we are, right? We are on a mission to change the face of wealth. Listen, as these next few years come rolling by, I want it to be seen that women of color can be and are wealthy. You're wealthy. I'm wealthy. All the women around us, all the women of color around us are wealthy, so that our young women coming up behind us. My daughter is 6. I've got one who's 20. She's 27 now. Lord have mercy. She's doing her thing, investing. I've got a 6-year-old coming up behind her. They need to know that women of color can and are wealthy. All right. So you guys have an amazing day, and I'll talk to you guys next time. Peace.